Why do we suck at investing? Before we get right into this topic, there are a few terms that will be mentioned that you might need to remember. When we talk about the market, the term that we are referring to is a stock index. Stock indexes are a collection of companies put together by virtue of their size. A bigger company, such as Reliance or ITC, will automatically have a greater weightage in the stock index than a smaller company such as Tata Motors. In India, we have the Nifty 50, which is a collection of the 50 largest companies in the Indian market. In the US, the most commonly referred to index is the S&P 500. The last thing that you need to remember is the definition of a successful investor. Sophisticated financial models have been developed to help determine this baseline. But for the purpose of this video, let's keep it simple. A portfolio of stocks is deemed to create value for its owner if it manages to grow faster than the market over a long period of time. Your definition of long term can be dependent on when you will need the money. Okay, let's get back to it. So, why do we suck at investing? Over the last 30 years, the Nifty 50 index has grown at an annual rate of 13.5. Rupees 100 invested in stocks back in the 1990s would have grown to 5,161 in the year 2021. That means that in a 31-year period, the Indian stock market has grown by around 51.6 times. That is the kind of competition that all long-term investors have to deal with. Just take a look around you and ask yourself how many people have actually created a portfolio that has grown 50 times in the last 30 years. Back in 2007, Warren Buffett made a famous bet. He bet $1 million that an S&P 500 index fund would outshine a basket of hedge funds over a period of 10 years. For a man who's so famously frugal, this seemed like a really reckless bet. What's actually shocking is how easily Buffett won it. The S&P 500 returned 7.1% annually, whereas a basket of the best hedge funds only returned 2.2%. Hedge funds are supposed to employ the smartest minds and have access to all the information about a company. Yet even these managers could not beat the market. How can a regular investor like you and I expect to outperform the market? What are we missing here? The human mind is automatically prone to several biases and illusions. The truth is, we often think that we are at least better than average. However, if all the students in a class are above average, then mathematically no one is. Daniel Kahneman is a Nobel laureate who spent most of his life studying human nature and the ways that we are suspect to biases and cognitive illusions. In his book Thinking Fast and Slow, Kahneman talks about his countless thought experiments on human behavior and decision making. Halfway through this book, it becomes increasingly apparent to every reader that humans are not linear thinkers. We live in a world where perception and presentation can change the way we make simple everyday decisions. When faced with a difficult choice, people more often than not will make decisions that contradict rational logic. In this video, we will talk about 5 cognitive biases that can influence your decision making on a day-to-day basis and hence put your investments at risk. Meet System 1 and System 2. The human consciousness in all of its distracted majesty can be broken up into 2 distinctive sides of the same coin. Let's refer to these pieces as System 1 and System 2. System 1 is always awake. It is involuntary and cannot be controlled. Although it's always active and responding to external stimulus, there is not a single point where you need to actively engage it to make it work. It regulates how your body feels, your reflexes, and your immediate emotional responses to external stimulus. System 2 is part of the conscious mechanism of your brain. This is the slow, deliberative, and accurate half. System 2 is not always engaged because in order to work, the brain needs to consume energy. And humans by default like to take the path of least resistance. To demonstrate how System 1 and how System 2 work differently, you need to take a look at the following examples. This image is called the Muller-Lyer Illusion. As you can see, there are two lines A and B with two projecting fins on both their ends. To most of us, line A definitely appears to be longer than line B. However, the following visualization will now show you how this image was created. If you had seen the previous image with your whole attention, you'd be pretty surprised when I showed you that both line A and line B had the same length. But what's more surprising is your intuition doesn't want to believe what's being shown to it. In order to truly believe what you are seeing, you need to actively engage your system too. And remember that when dealing with fins projecting out of straight lines, your system 1 or intuitive answer is inaccurate, and you need to verify the lines more closely. The reason why our intuition can handicap us during our investment career is that it's very easy to believe that your portfolio is doing well. Most of the portfolios that we get to see only contain the successes. Realized losses can no longer be seen because the owner has already sold those shares. This leads us to believe that there is value and money being created, even though the evidence shows us otherwise. The law of small numbers. The law of small numbers refers to a very common mistake people make when it comes to making predictions or gauging probability. The simplest example of it is when we toss a coin. Every time a coin is tossed, there is a 50% chance that it will land on heads and a 50% chance that it will land on tails. However, imagine there's a situation where you get 5 straight heads. What do you think the outcome of the next toss will be? Because we have been exposed to a previous outcome, in this case the 5 previous coin tosses, we will want to believe that the 6th toss will be a tails. However, this idea is wrong, because the outcome of each coin toss has no bearing on the next one. The reason that we make this mistake is that humans tend to put too much faith in small amounts of information. I will take this opportunity to use the law of small numbers as an example of System 1 thinking in action. Much like the lines in the Muller-Lyer illusion, we want to believe that the next coin toss has a higher probability of being a tails. However, we need to engage our System 2 thinking and remember that previous outcomes have no bearing on the next coin toss. If you take a look at when IPOs and other public offerings come out, it is always at the end of a stock market bubble. Take a look around you today. Due to a period of record low interest rates and relatively under control inflation, we are witnessing a huge bubble in the stock and crypto market valuations. The appeal of investing is really at an all-time high. These companies make investing look so simple and easy. When novice traders take a look at the stock market's performance over the last 12 months, it is almost certain that they will be blown away by stories of how people have doubled and tripled their investments. Now, it's not that I'm saying all these success stories are fake, but if there's one lesson that can be learned from the law of small numbers, it is that just because good things happened in the past doesn't mean that good things are guaranteed to continue in the future as well. The illusion of control. Us humans are an interesting bunch. We look for patterns in everything that we do. The illusion of control refers to the tendency of people to believe that they can influence the outcome of an event or detect signals that will help predict a certain outcome. If you've ever seen a friend put on a lucky jersey just before watching a match, then you are witnessing the illusion of control in action. Humans try to detect patterns in their environment all the time. This is because it makes learning easier. For example, if you're given directions in an unfamiliar city, you can try to memorize each turn. But if you see a pattern, even complicated routes will be easier to remember. In a famous study on human behavior, researchers set out with the objective of determining how far people would go to detect patterns. The experiment was set up so that participants were led to believe that they would be able to turn on and off a red light in a lab. just by pushing a red button. The volunteers were told that just about anything they did could influence the turning on and off of the light. The truth, however, was that the lights turning on and off were completely random. However, the researchers kept this tiny bit of information just to themselves. All the participants were given 15 minutes to find out what made the light go on and off. Once the experiment began, participants would close their eyes, stand up, turn around in circles, and even come up with complex patterns that would help them predict when the light would go on and off. More than half the participants in the study felt that they had cracked the code behind the blinking of the red light. When it comes to investing, all of us are highly prone to the same cognitive bias, the illusion of control. We look for patterns all around us by trading only on certain auspicious days or finding the bottom using candlestick patterns. We fool ourselves into thinking that we are in control and have bought some stock for cheap without doing any research. More often than not, we will realize that we paid a hefty premium. It's just that when we realize, it's all too late. The availability bias. The availability bias is the human tendency to assign a greater probability of occurrence to events that can be recalled more easily. The reason why certain events are called to mind more easily is because our brains rely on a cognitive shortcut known as the availability heuristic. This reliance helps us avoid stressful fact checking, but also increases the probability that our decisions will be flawed. An often used example of the availability bias can be found in the media. Unfortunately, every now and then, there is an element of bad luck or mechanical failure that causes a 150 passenger plane to crash. More often than not, when this happens, there are no survivors. Airplane accidents are an extremely tragic way for people to die, and the media does its job by covering the event extensively. I'm sure most of us have heard of the phrase, you have a better chance of being struck by lightning. It is used to indicate that a certain outcome has a very low probability. An example of this statement in action is my flatmate has a higher chance of being struck by lightning than getting a girlfriend anytime soon. Most people don't think that death by lightning is even possible. If you were to go about asking the same question right after a plane crash, almost everyone would agree with you. However, here are the statistics. Every year, around 2,360 people are killed by lightning in India. Needless to say, death by lightning is definitely a real cause of death in the world. But how many people do you think died in a plane crash? According to a survey, 2,173 people have been killed in air crashes and plane crashes in India since 1947. In the entire independent history of our country, only 2,173 people have died in airplane accidents. But why is it that people become scared of flying right after a plane crash? Is the same fear present when it begins to drizzle? Much like plane crashes and lightning, the media covers stories that people find relevant, tales of riches and wealth. For every one article that talks about a student or a salaried person losing the entire family fortune on gambling in the stock market, there are hundreds and thousands of stories about the Warren Buffetts and the Rakesh Junjunwalas of the world. Even when talking to friends, no one will willingly come forward and tell you about their losing trades. It is only the successful ones or the multi-baggers that reach your ears. In an environment such as this, it is easy to assume that investing is really easy and just about anybody can do it. The reality, however, is not everyone is generating alpha or beating the market, and that your success isn't guaranteed either. Prospect theory. Prospect theory assumes that everyday people value losses and gains differently. If a single choice is presented to people in two ways, one positive and one negative, a person will pick the former choice. This is due to a phenomena known as loss aversion. An example of prospect theory can be thought of using the following visualization. Imagine that you walk into an antique shop with a family heirloom. You are here because it no longer holds any value in your eyes, and you would like to instead use that money to invest in your future. The shop's dealer, on seeing the heirloom, marvels at it for a while and decides that he wants to buy it from you. He says, I will pay you rupees 5,000 for that heirloom on the spot. In addition to this, because you have made a good impression on me and I want you to be a regular customer of mine, I will offer you an additional 2,500. Or, if you feel like you'd like to gamble, we can toss a coin, and if you win the toss, I will pay you a sum of 5,000 rupees more. After hearing the antique dealer, you decide to walk down the street and evaluate your option. As you reach a junction, you notice another antique shop and you decide to enter and see what this store has to offer. The shop's dealer, on seeing the heirloom, marvels at it for a while and then decides that he wants to buy it as well. This is how this shopkeeper frames his offer. Under normal circumstances, I would pay you rupees 10,000 to buy your heirloom on the spot. But since times are tough and business is hard, I will not be able to offer you such a high amount. Instead, here is what I propose. You can sell your family heirloom to me for rupees 2,500 less, or if you feel like you'd like to take a gamble, we can toss a coin. If I win, you have to pay me back rupees 5,000, and if you win, you get to keep the whole 10,000. You listen to the dealer carefully and walk out of the shop. Here is a visualization of the two offers. If you are like most people, the offer from the first antique dealer is much more attractive. However, this is because your system 1 is telling you so. Engage your system 2 and see if there's actually a difference between offer 1 and offer 2. In both offers, you are faced with two choices. If you take the sure thing, then you will be richer by rupees 7,500. And if you take the gamble, you will be richer by rupees 10,000 or just 5,000, depending on whether you win or lose. The reason why this is important is because prospect theory says that losses have a greater emotional impact for investors than gains. In fact, it is believed that most investors would need at least a 2:1 return on an investment or gamble before considering it. This is known as being risk averse. Needless to say, in everyday life, this is a massive handicap for the investor. Conclusion. The aim of this video was not to discourage people from investing. In fact, I'm going to set the record straight. Investing in the stock market is one of the best ways for anyone to secure their long-term financial future. However, without a watchful eye, it's really easy to fool ourselves into thinking that our investments are beating the market or even keeping up with it. The reason why the cognitive biases covered in this video are significant is because once we know about them, a conscious effort can be made to avoid them. The next time you're making an investment, remember that this is your own hard-earned money. Whatever decision you take needs to be rational. Writing down investment decisions on paper is known to activate your system 2 thinking. This makes investors less prone to impulsive buy or sell decisions that they might regret later. If you notice yourself being jittery or jumpy before making a big investment decision, this might be indicative of a system 1 control decision. Much like the lines in the Muller-Lyer Illusion, we need to remind ourselves that our intuition can be misleading. Hey everyone, I hope that you enjoyed this month's video. A lot of the changes that you see this time round were based on your very own suggestions. For the short term, I have decided to invest in a video animation software. Do let me know if you enjoyed seeing these little guys. Maybe they'll become a regular part of the channel if you do. I certainly really enjoyed researching and executing the script for this video and can't wait to show you what's in store for the future. If you feel like you learned something from this channel, don't forget to like, share and subscribe. If you have any suggestions or tips that you would like to see next time, please feel free to add your comments below. If not, keep smiling, and until we meet again, this is FilterCoffeeFinance signing off.